Would you bet your entire savings on one cricket ball? One yorker could clean the batsman. Game over. Yet many traders do the same. They put half or more of their account in one trade. One bad move, and the account is gone. Smart traders never bet the farm. They follow the 1% rule. Risk small, play long. Most traders don't think about size. They focus on entries and targets. But position size decides survival. Example, a trader with 500,000 rupees risks 100,000 rupees in one HDFC Bank trade. One sharp fall, and he loses 20% of his account. Recovering that loss may take months. Another trader risks 50,000 rupees in Bank Nifty options. One RBI news wipes it out in minutes. Capital gone. Confidence broken. Oversizing is the silent killer of traders. Numbers prove the point.
Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
SEBI report 2022, 9 out of 10 retail traders lose. One main reason is risking too much in single trades. Risk return math: lose 10% of your account, you need 11% to recover. Lose 50%, you need 100% gain. That is very hard. Global hedge funds: most big funds risk only 1 to 2% of capital per trade. Their goal is survival first, profit second. Zerodha study: survivors among retail clients trade smaller and last longer than aggressive traders. Practical test: if you have 1 million rupees and risk 1% per trade, even after 20 straight losses you still have 800,000 rupees plus. But if you risk 10% each trade, 10 losses in a row wipe out your account. Example, US trader account equals $40,000, risk equals 0.5% equals $200. Even after 20 losing trades, loss equals $4,000, 10%. Still safe. Example, Indian trader account equals 500,000 rupees, risk equals 1% equals 5,000 rupees, stop loss equals 50 rupees in Reliance, position size equals 100 shares. Even after 10 losses, down only 10%, still in the game. This is the power of small risk. Why do traders ignore size? 1. Greed. Hoping to double money, they buy too many Infosys shares. 2. Overconfidence. After 3 wins in Bank Nifty, they think rules don't apply. 3. Impatience. They want to become rich in months, not years. 4. Ego. Believing, I can't be wrong on HDFC Bank. 5. Revenge. After a loss, they double size in ICICI Bank to recover fast. 6. Illusion. Thinking more size equals more profit, forgetting more size equals more loss. 7. Hope bias. Believing, this trade will definitely work, and overloading in TCS. The mind loves shortcuts. But in markets, shortcuts mean wipeouts. Ravi in Bank Nifty. Ravi risked 20% of his account in Bank Nifty options. One RBI policy move crashed the index. Half his account was gone in minutes. He quit trading. Meera and Reliance. Meera followed the 1% rule. 1 million rupees account, max 10,000 rupees loss per trade. She faced 15 losses during volatile months. Her account was still safe. When markets turned, she recovered and grew. Arjun and Infosys. Arjun ignored sizing. He put 2 lakhs in one Infosys trade. Bad earnings cut stock 8%. He lost 16,000 rupees in one day. He realized size was more important than setup. Kavita and ICICI Bank. Kavita traded ICICI Bank with 5% risk per trade. 2 bad trades in a row cost her 10% of her account. She felt hopeless and started revenge trading. Losses doubled. When she switched to the 1% rule, she regained control. Nifty 50 example, during budget week, Nifty 50 jumped violently. Traders with 1% risk survived. Those who went all in got wiped out. Stories prove, position sizing is the real shield. The formula is simple, position size equals account size times risk percent, divided by stop loss points. Example, 1 US trader, account equals $40,000, risk equals 0.5% equals $200, stop loss equals 10 points, position size equals 20 shares. Example 2 Indian trader, account equals 500,000 rupees, risk equals 1% equals 5,000 rupees, stop loss equals 50 rupees in Reliance, position size equals 100 shares. Example 3 Bank Nifty futures, account equals 1 million rupees, risk equals 1% equals 10,000 rupees, stop loss equals 100 points, position size equals 100 shares, 2 lots of 50. Step by step plan. 1. Write down account size. 2. Fix risk percent, 0.5 to 1%. 3. Decide stop loss points before entry. 4. Apply formula. 5. Place trade only if size is within limits. 6. Never increase size mid-trade. Golden rules, never risk more than 1% on any trade. Never risk more than 3 to 4% in one day. Small risk equals long career. Exercises to practice, do mock trades in Bank Nifty using 1% rule for 1 month. Record results in journal. Notice how small losses feel manageable. Train yourself to think survival, not jackpot. Scaling up, once rules become habit, increase size slowly. From 10 shares to 20 shares. From 1 Bank Nifty lot to 2. Always grow with discipline. Would you bet your life savings on one cricket ball? Then why risk it all on one trade? Oversizing destroys traders. The 1% rule saves them. Reflection. Calculate your next position using the formula. Action. Write the 1% rule on a sticky note and place it on your desk. Final analogy. A batsman does not hit sixes on every ball. He builds innings with patience. A trader must do the same. Risk small to play long. The 1% rule keeps you in the game.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.